Welcome back, y'all, and good morning, but welcome back to Real Estate Mindset. This morning's video is going to be absolutely live and absolutely bonkers. And if you guys can, please remember to like this video. But this is day number 6 of my ice bath plunge journey. And I got to tell you guys, I absolutely love jumping in and soaking in ice water. I never thought that I would love that, but it definitely helps with stress. And you guys, I am stressed a little bit because people still think that real estate never goes down. But I'm going to tell you guys this, okay? People ask me, and I hate to do this to myself and really anyone else, or when's the best time to buy? When's the best time to buy? Now, I've been thinking about this a lot. As you guys know, I've extended my own lease on this house right here. I have extended that, and I'm going to get to your question, Vital. But, the thing is, normally, and I believe the best time to purchase real estate is generally always between December and February. Okay, so generally, if you have to buy this year, so be it. Do it cautiously, but generally the best time to buy between, again, December and February. And I think that, again, the best time is going to be buys now during that time frame in 2024 and 2025. So we'll see more of that moving forward. Now, I threw up Vital Sign's comment here because I understand why he feels that way. We had, I don't know if anyone's listened to Jerome Powell yesterday, you guys. It was so weak. It was pretty pathetic. He wasn't even answering direct questions, and there was a tremendous amount of questions regarding the housing market. But the reality is people are buying right now. Affordability is going to be the key to buying right now and being able to afford a house. Obviously, guys, inventory is also key. But what's really interesting is the video that I'm going to release this evening, I did a complete analysis on Texas, the 4 main metro areas in Texas. And I looked at categories like unemployment, migration, equity run-up, inventory, permits, and unaffordability. So I looked up all 6 of those factors for the 4 metro areas in Texas. And, what I found is inventory is not the lead. For Texas, inventory was actually not what was leading the price decline. Which was really surprising. And neither was unemployment. It actually appeared, at least in Texas, that unemployment overall had no impact on prices. Blew my mind, you guys. So that video is going to be today, complete rundown on Texas. A lot of patterns I'm starting to find when I'm really analyzing the data. So Vital, brother, I hear you, man. Hang in there. But again, usually when the pivots and things like that start happening, that means there's really horrible things to come. Usually that means that. And the guys, he didn't say pivot, all right? They said pause, but they also said skip. So can we just use the word skip so we don't all get triggered? But I'm going to go into all that stuff today, you guys. Vital, I absolutely love you. Good morning, Scared. AJ, Francisco, the original champion Deuster. He's no longer the champion. Juliet, good morning to all of y'all. Definitely appreciate you. Here's my man, Johnny. Johnny keeps me accountable, especially when I don't like it. So, Johnny, good morning to you, sir. Love you, man. TNT, what's up, TNT? AJ, Kim, we're going to get started, guys. Let me just go to the bottom here. Oh, Medic. Medic's here. Medic, be cautious, dude. Don't be afraid. Medic, listen to me. Okay, so Medic sold his house, okay? He cashed in. That's cool. I may do the same thing myself because I see these prices right now. But the thing is he's moving to Boise, and Medic, again, like I'm saying, man, if there's any way, maybe you can live with your parents for just a little bit. Again, generally, and we saw that on my channel. Remember that when I was doing the market analysis, December to February, or even November to February, right? But if you're going to buy, and you got to buy this year, at least wait to the end of the year. And by that time, again, we should have a few things more happening so we can get a better, gauge on this. Nikki in the house. Volvo, my man, Volvo. Nikki, Jim, yes. Okay. Shocker was Dallas, Jim. The shocker was Dallas, man. Like Dallas, Broadwick, what's going on, Broadwick? Dallas caught me by surprise, man. Dallas caught me by absolute surprise. And also what caught me by surprise is the fact that unemployment had apparently no bearing on the prices whatsoever at this point. So I think you guys are going to love this video. It's allowing us, again, to see a whole bunch of data, figure out why are prices going down in some areas and not going down in other areas. Is it just inventory? Is it unemployment? Is it unaffordability? What is driving price decline? So I really narrowed that in Texas. I think you guys would be proud of me. But what we're going to do today, guys, is I'm going to go over basically the market. We're going to talk about interest rates. We're going to look at the Fed Watch tool as well to see what the market's pricing in as far as additional rate increases from the Federal Reserve. The market is actually pricing in an increase of interest rates in July. It's literally pricing that in right now. But after that, guys, let me show you what we're going to do. We're going to briefly go into, let me hit this right here so I can just transition. We're going to go into, just a brief breakdown on what happened yesterday and why economists say it's near certainty that housing inflation will soon fall. And it kind of, because I'm like, okay, what's your angle here? What's your angle here, economists? So we're going to go into that, and then we're going to go into this article, which is really crazy. So everyone, including me, including my man Vital, are like, oh my God, the housing market's rebounding, when the reality is they're the negative equity that we lost in Q1 of 2023. Oh my gosh. So we're going to go over the reality of, like, I think, and I see this, a lot of my channels, some of the people, and this happens to me, that is a little bit more desperate. Like, I'm a little bit desperate here, you guys. The media is rubbing off on us, right? The narrative is rubbing off on us, at least in my opinion. Now, after that, guys, we're going to go into the mortgage monitor, which is really cool. It's going to have some charts we're going to look at as well. We're going to go into that just to get an indication of what's happening in financing, because what we want to see is credit restrictions. So we're going to see if we can start finding credit restriction. And as always, y'all know how I like to end my lives. I want to end my lives on showing people how to find a good deal and actually using the data. So at the end of this live, I'm actually going to do a market analysis on Artavia. So Artavia is a new home building community. That was for Dan Carr. I don't see him online, but I've been promising him that I would do that market analysis for him. So hopefully he'll be online. Anyways, all right. So you guys, I'm going to get started here. But I definitely appreciate you guys. Don't forget to like the video, please. Okay. And a lot of stuff going on with the National Association of Realtors that I'll be getting into as well. But let's start here. So I'm going to show you guys, we're going to go over now what the market thinks that the Fed is going to do. Okay. We can argue, basically the market the entire time has bullied Jerome Powell and the Federal Reserve, basically kind of thinking that they're weak and not going to back up what they're saying. And I can't blame them for thinking that, because that appears to be what's happening. But it is important to see what the market's pricing in. Now, the way I'm going to do that, guys, is I'm going to use a tool called the CMA Fed Watch. Okay, so we're going to look at the CMA Fed Watch. I'm sorry, we're already 7 minutes in here. We haven't even looked at the CMA Fed Watch. So we're going to go into the CMA Fed Watch, y'all. And what I'm going to do is, let's pull it up right here. Just want to make sure StreamYard is not glitching this morning. StreamYard has some issues. Liberty Hills. Okay, I just got another. Okay, so here we go, guys. So this is CME Fed Watch tool. Okay, let me refresh it. Now, I just wanted to point out this. Okay, so first of all, the market is saying that in July, there's a 64% likelihood that the rates will go up. So again, as of right now, at least, the market is pricing in and saying that the Federal Reserve will hike interest rates again in July, which is very interesting. Okay, so you can see that right here. Now, the morning started out at 71%. So this has actually gone down about 6.5% roughly from where it was at this morning. But regardless, the market is saying a rate hike in July. But take a look at this, you guys, September. Okay, take a look at September. So they're saying September, no rate hike. Okay, so in September, they're saying overall no rate hike. Even though the premise is there's going to be 2 additional rate hikes, the market is not pricing. What I'm saying is the market is not pricing in 2 additional rate hikes. The market is pricing in only one. Yes, timestamp. Sorry, Kim. I got that timestamp. One additional, I'm going to put that timestamp right here. One additional rate hike this year, not 2. So Federal Reserve in the meeting, they said 2 rate hikes. Market saying, nah, only 1. We're going to give you only 1. And it's going to happen in July. But there's also saying there's a 30% chance they're actually going to cut rates in September. Pretty shocking. Let's go to November. Okay, November, same thing here in November, pretty much as September, basically a 57% chance no hike and a 31% chance of decreasing rates. Now we go to December, And December's all over the place. So December's pretty much a toss-up as far as the market. But this is a really cool tool, guys. If you want to watch how the market is viewing what the Fed is going to do next, see, this has already gone up. So just since I've clicked and shown you guys this stuff, okay, I see you, Nikki. I see you. Oh, Melissa's in the house. We got one of the champions. Melissa and Davis, the champions. First place comment champions. So, Nikki's like, encourage people to sell. So let me touch on that real quick as far as selling, you guys. I'm considering selling my rental, and darn it, I just dropped my pen. I'm considering selling my rental, not because I want to. The cash flow is great. I've worked so hard to get just one asset, but these prices, I mean, you guys, they're almost at where they were last year. And I may take that money and just buy another rental, or I'm sorry, or use it to my primary residence or something. I don't know, but it's very appealing to me right now to actually just cash out. And really, give me 1 second, y'all. I have to pick up this pen. I'm so sorry. This is so embarrassing. All right, there we go. Got it. Now, totally lost my train of thought. Okay, totally lost my train of thought. But let's go on to the next thing. So I'm considering selling my house right now. It is a pretty good time to sell your house. So in other words, you didn't miss the boat yet on it being an incredibly good time to sell. Now, you're not going to get as much overbidding, not anywhere close to the overbidding that we got last year, but as far as like what people are paying right now, it's crazy. So anyways, this is the Fed Watch tool, you guys. Again, 67% chance now, rate hike in July. That's next month as well, July 26th. Let me refresh it and see if that's changed. And look at it, it's just gone back down to 64.5, but it's staying in the mid 60s as of right now. Now take a look at the 10-year. The 10-year this morning, look at this. This is the 1-day chart. So this is crazy because we started out this morning. I was watching it all morning. But around about 8:23 a.m., at least Central Time, it went straight down. I'm sorry. But we don't want it to go down. Okay. But it went straight down at about 8:23. So it started the day up, guys. The 10-year was actually up around, I think it was 5 basis points. It was around 3.83. You guys can see that right here. And you can see that timestamp. But shortly after 8:23 and like right before the market opened, look at this. The 10-year has plummeted. Now, odds are what's going to happen as a result of the 10-year plummeting like this is mortgage interest rates will also go down. But let's take a look at mortgage rates, okay? So here's mortgage rates right now. Now, obviously, the average person is probably getting an interest rates in the 7% right now, which is why I'm always telling you, if you are on the sidelines, increase your purchasing power, credit, income, and assets, because if you don't have great credit, odds are you're going to get dinged with fees and penalties and things like that. And I also agree with what Vital Signs is saying down here. The market does not believe the Fed, and they believe his hawkishness as a bluff. Yeah, I agree. I agree with that, Vital. But I'm thinking beyond that, right? I agree with what Vital's saying, but I'm thinking a lot of the things that Vital's saying. But the thing is, guys, is like the housing market is way over. It's just overheated. It's amazingly overheated right now. I mean, literally, as soon as we get a type of black swan event or institutional liquidation of SFRs and things like that, we're going to have inventory growth. We will. We just got to get through a certain seasonality, and we really got to get the message through to most people that it's in my opinion, is best to wait. Now, I know, again, most people right now are battling affordability. I had Minority Mindset on yesterday, and his point was buy a house now if you love it and you can comfortably afford it. So that was his take on everything. I'm a little bit more cautious than that just because of how overheated everything is. But anyways, you guys, so interest rates will probably update, I don't know, in another hour or two, and it's probably going to show a decline of, I would say, probably it'll go down to like 6.85. So I'm going to say there's going to be a 12 basis point decline. Let me write that down. Let me see if I can get that accurate. 12 basis point decline. Last time I got it exactly right. So anyways, that is the market stuff, you guys. Now, inventory Vital is, depending on the metro area, it's basically completely sideways. In other words, it's not dropping or increasing. It's just staying sideways on a national average. And I actually looked at my own housing market. It's the same thing in my own local housing market. It's like staying sideways. It's the craziest thing ever. But again, we're heading into now like the juicy months, June, July, August. And if we don't have that inventory jump, this spring and summer like we should, it's going to take even longer for things to get back to normal, regardless of whatever side. If you're bullish or bearish, things are just going to progress longer. But here's what I want to do, guys. Let me go into this right now. And this is a bit of a breakdown. I think you're going to like this article. We'll move on to the negative equity as well. Let me put a timestamp down on the inflation report. Now, you guys may have watched that press conference yesterday. If you didn't, you don't have to. It's a complete waste of time. But this is going into basically some of the things that Jerome Powell refused to answer. There's many questions about shelter, core, CPI, housing. And the dude literally went to his book. Oh, Jeff is in the house. What's up, Jeff? He went to his book and he started reading off of a script he made to answer the questions. It's like, bro, you didn't even act like you were being yourself. Really horrible. I was really disappointed. And yesterday was the first time I looked at Jerome Powell as useless as Ben Bernanke. I still had faith in Jerome, but yesterday, y'all, it's just gone. My faith in him is gone because he couldn't answer very important questions for us that we have a right to know. And this guy's messing with all of our lives. We have a right to know certain things right now. Anyways, the name of this article is from CNBC. I'm going to link it in my description, and this is going to be timestamps. Why economists say it's a near certainty that housing inflation will soon fall. Vital, where you at? Vital, where you at? Jeff, where you at? Johnny? Which, by the way, I have a bet with all of them. Powell said a lot of things. One thing that also Powell said, he said the housing market is rocked. Is that what he said? Jeff, you would probably be impressed, but I actually took notes on almost his entire speech. And then I was just like rolling my eyes. What did he say? Boom, boom, boom. Oh, housing is wrecked. Yeah, housing is weakened. Housing is weakened. But he said it with passion, like housing is weakened. Well, no, I don't, sales are down. Yes, sales are down, and that's what he's talking about. But like for consumers, nah, it's not really weakened. It's actually a type of runaway inflation situation. That's probably why he didn't take any questions. But anyways, let's read a little bit about shelter and the housing market and why some economists are saying, don't worry, housing market's next. Okay, so let's see what they have to say. Now, the three key points. Number one, shelter is the largest component of core CPI, not C. Oh, okay. Well, anyways, it's 10% CPI, 40% corporate CPI. But anyways, shelter is the largest component in consumer price index, which means it's super important to talk about the housing market. So Federal Reserve, Jerome Powell, start answering questions when people are directly asking you. The housing market is what we care about. We don't care about eggs. Well, I care a little bit about eggs, but I care a lot more about where I'm going to live, right? I don't want to live here anymore. Anyways, number two, the category, therefore, has a big influence on the direction of overall inflation, okay? The housing market is so sticky. It's so sticky, and it is sticky because, again, they injected all of the liquidity into the bedrock of that housing market. So the reality is, and this really sucks, I think there's going to be a tremendous amount of pain, and I think really that's the only way to get the housing market balanced. How else can we? How else can we get balance? I mean, they're not building enough. They're not building things for cheap enough. It's not quality. It's going to take pain from people that are essentially innocent. And that's super sad. Anyways, housing trends feed through to the CPI with a substantial lag. Economists think a reversal is essentially guaranteed in the second half of this year. So they're saying, like, don't worry, guys. And I'm saying as well, don't worry, guys, right? Around the end of this month is when it will start to show price decline. And eventually it's going to do that whiplash downward. At least that's what I believe. I hope it's at the end of June. Should be. But again, who's in control? The Federal Reserve is in control. And people with money, consumers with money or debt. So because they're spending, right? So it is a lag, you guys. Let's keep reading. Okay, housing is perhaps the most consequential category in the consumer price index and key inflation barometer. That's probably why Jerome Powell got so many questions about it yesterday. Anyways, I'm still frustrated. As the largest expense for an average U.S. household, shelter accounts for more than 1/3 of the CPI weighting the most of any other consumer good or services. That gives housing an outsized influence on the overall direction of inflation data. Yet again, his answers and from the questions he was getting in the housing market, it showed Jerome Powell was incredibly he just looked a mess. He looked a mess. He looked dovish. He didn't even look like he was backing the expectations. So just really disappointing. Maybe there's something horrible that's happening that we just don't know about, and that's very realistic. For example, something in commercial real estate can be breaking. We just don't know about it. Maybe they, you know what, Vital? Maybe they're doing the right things, and we just don't think they are because we can't see the incoming pain per se. That's a possibility. Think about it. That's generally what apparently is supposed to happen. Anyways, so it is stubborn, but look at this, guys. Here's the U.S. Consumer Price Index going back to 2020. So we started, January 2020 at 2.5% inflation. So inflation, the rate of inflation has gone down to 4%. But if you look, we're still at essentially the same prices as we were in 2021, mid-April, as far as inflation growth. So yeah, on one hand, it is going down, but it is still way high. All right. And also, when you look at the less food and energy, inflation really has only gone up. Y'all see this? Y'all see that? Inflation has only gone up. That's insane. What is this? So when Jerome Powell was talking, he was just like, "Oh, we look at more than the housing market. We look at many things." And I'm thinking to myself, like, well, when we take out food and energy, it looks like you've made no progress whatsoever. So the whole skipping thing, again, Vital, I'm hoping, they probably know something that we don't know. All right, but let's keep reading here. All right, I know this is about as high a degree of confidence as one could have. Now let's go into the shelter. Okay, how shelter prices have changed. Price changes in shelter were generally muted before the pandemic, but COVID-19 warped that dynamic and essentially broke every single fundamental. Fundamentals are broken in the housing market right now. I don't care what side of the coin you're on, bullish, bearish. The fundamentals are broken from an income and affordability standpoint. Housing costs shot up, but have slowed and even started to fall in some areas, economists warn. Now, again, on average, we're still down year over year. The housing market has it has come close, I admit. It has still not rebounded to what it was last year. Again, it is dangerously close. That's why we don't just look at year over year. So it is dangerously close. Now, let's keep going. CPI isn't a particularly accurate gauge for housing. It's not an accurate gauge at all for housing because it's not showing that housing is incredibly sticky with inflation. Here's the problem. The CPI doesn't capture those price trends in real time. It operates with a substantial lag, and that's why there's so many revisions. We can't even believe the information because they're always making revisions, and usually it's worse. This last time it was actually better, which is interesting, meaning it can take 6 months to a year for a decline or increase in current housing prices to fully feed through the inflation data. So they're saying just everyone wait, it takes more time. That's what they're saying, okay? And that's what I'm trying to tell y'all, but I want y'all to hear it from these people, okay? It's not necessarily a particularly accurate gauge of what's going on in the housing market right now. Blah, 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 blah. We already read that. Here's the reason for the lag. The U.S. Bureau of Labor Statistics collects rent data from sample households every 6 months. Okay, so holy smokes, every 6 months. The BLS also divides the sample households into 6 different subgroups and staggers when it collects data from each. In other words, you guys, it's like, what narrative do they want to use to appease everyone? I mean, the Fed is busy trying to make everyone happy. I feel like they just use whatever index that they want, and they just keep changing it, like for like used car. I won't go there. I want to keep it about real estate. Why economists think housing inflation is poised to fall. Okay, shelter is still playing a big role in inflation. Yes, we know that. Why doesn't the Federal Reserve seem to acknowledge it? To a big role in inflation, but that should be slowing in the second half of this year, which means it did not slow the first half of this year except for Q1, and you guys will see that. So what the heck is Jerome Powell talking about? Vital, am I right? Vital, what's he talking about? He said we bottomed? What? Inflation is still there. Anyways, the latest CPI reading issued Tuesday showed a monthly increase, not decrease, in shelter of 0.6 in May from 0.4 in April. So again, it's showing us that inflation is still in the housing market right now. And in fact, if it goes above, if median sales price goes above last year, y'all, I mean, we should all acknowledge that there's a runaway inflation problem. Okay. But a decline in CPI housing inflation is almost as much of a certainty as you can get. Do y'all hear me on this? Okay. This is what they said. The decline in CPI housing inflation is almost as much of a certainty as you can get. But what do we want? We don't want, disinflation, right? We want deflation. And as long as there's like enough pressure for prices to to have disinflation, I believe that with disinflation, when you add to disinflation, when you add seasonality to the disinflation, that's why we're getting price decline. That's why the price decline that I'm telling you guys about is exceeding normal seasonality. And again, we already saw that last year. And why wouldn't it happen again this year? Can anyone explain, Vital? Think about it. Think about this, Vital. Why wouldn't the same thing happen this year when we're even in a worse situation? We're in a worse situation last year, Vital. We have more inventory. Everything's more expensive. People in more debt. Why wouldn't the same thing happen this year? Think about it, right? I mean, you know what I mean? See where I'm going with that, brother? Anyways, there's an additional measurement that's relative to housing inflation. The BLS tries to access price changes for homeowners as well as renters in a subcategory called completely useless and doesn't matter, or owner's equivalent to rent. Okay. So that's what they're using. They're using the owner's equivalent of rent. The measure is essentially a survey. They're using a survey that reflects the price homeowners believe, whether it's emotional belief or with data, okay, believe that they can get if they were to rent out their home. So I'm thinking to myself, so you're saying that the people in charge of our basically in charge of our lives and finances and economy are using a survey from homeowners to dictate what they do next. Okay, just letting you guys know how that works, all right? While somewhat tied to market rents, homeowners aren't necessarily feeling those inflationary pressures, especially those who have fixed rate mortgages and own their home. So, anyways, when all is said and done, these economists are saying it's coming. I'm saying it's coming. Unfortunately, right now, we don't see it, right? Well, we don't see it in the demand in the housing market. We don't see it in we don't see it in the inventory. We don't see it in price decline. Because why? Because prices are going up right now. So that doesn't mean it's not incoming. And I'm pretty sure you guys know that. But now let's add even more to this equation, okay? And this is why technically I think it's a type of runaway inflation that we have right now, but at least we haven't exceeded last year, okay? If we exceed last year, it's absolute runaway inflation. But here's the thing different this year versus last year, okay? Last year, Q1, everyone made money, pretty much, that owned a house, depending on the metro, but pretty much everyone made money. Q1 of this year, we lost over $100 billion in equity. So we've had what, 4 months of equity run up, and people are already freaking out. Look at history, look at the trends, right? But take a look at this article now. I think you guys are going to love it. It is a CoreLogic. I haven't read CoreLogic in a while because of just they're incredibly bullish. Homeowner Equity Insights Q1 of 2023, data through Q1 of 2023. Negative equity. So we're going to be talking now about, oh my gosh, I forgot to make a timestamp. We're going to talk about negative equity right now. And I think you guys are going to be surprised, okay? We're going to go over state by state. It's really actually very intriguing information, okay? But again, I'm just letting you guys know, there's a reality beyond our emotion. And I'm emotional with you guys. I'm emotional. I'm not saying you're bad for being emotional. I'm saying you're normal. But let's look a little bit further. Let's think a little bit further. Now, negative equity, often referred to as being underwater or upside down, which I'm warning people about. People don't know how bad that can be. And I don't want them to know how bad. I just want people to make the right decisions, and I can't make the decision for them, obviously, applies to borrowers who own more on their mortgage than their home is worth. And if you own more on your mortgage than your home is worth, you cannot refinance and you cannot sell. Negative equity can occur because of a decline in home value or an increase in mortgage debt or both. Okay, so now we're going to go into home equity Q1 2023. CoreLogic analysis shows U.S. homeowners with mortgages, roughly 63% of all properties saw their equity decrease, ouch, a total of $108.4 billion in the first quarter of 2022, a loss of 0.7% year over year. Okay. I think this is wrong, y'all. It says, look at this. It says 2022. You see this typo right here? Unbelievable. Like when I was reading that, I'm like, wait a minute. Did I misunderstand this whole thing? But no, it says it right here. So again, Q1 year over year change right here. Okay. So Q1 2023 overall, okay, according to them, CoreLogic, value has gone down 0.7%. Again, it could be more depending on how you look, but according to CoreLogic, that total is $108 billion. Just FYI, in the first quarter of 2023, the total number of mortgage residential properties with negative equity was unchanged from the fourth quarter of 22, representing a total of 1.2 million houses right now, okay, underwater. All right, 1.2 million or 2.1% of all mortgage properties. So 2%, it's actually not as bad as you'd think, but 2% of mortgage properties are now underwater, which again, considering a year ago, like 0%, right? It's like everyone was making equity. So that's a pretty big deal on a year over year basis. Negative equity rose by 4% to $1.1 million. Okay, so on a year over year basis, down 4%. Interesting. Okay. And look at this. All right. So here is the year over year change as a percentage and the total number of houses that are now underwater. And honestly, if they were to do this like realistically, it's probably a lot more than this, but just in one quarter, and this is not accelerating like in 2009 and 10, but Q1 2023, 4% negative equity loss, okay? An additional 50,000 homeowners joined the negative equity club. And honestly, guys, you don't want to join the negative equity club. The prices are definitely not favorable. So please do not join that club. A lot of people are joining that club right now. Now, home equity down year over year for the first time in over a decade. But, okay, so you hear this, but there's a but, remains strong. So is it a dead cat bounce? Is the same thing happening that happened last time? We're going to find out, aren't we? Now, in the first quarter of 2023, U.S. homebuyers with a mortgage lost a small amount of equity year over year for the first time since early 2012. All right? We're breaking records here, you guys. We're going back to the great financial crisis times. And we haven't even hit a recession. We haven't even hit unemployment. The unemployment has not started. I get we see headlines, Google, Facebook, who cares, right? Unemployment, I'm telling you guys, it hasn't even started yet. Not really. It has not even started yet. Anyways, while the national combined equity followed suit, as in the fourth quarter of 2022, Western states posted the largest annual home equity losses. Washington, on average, the average homeowner in Washington lost $74,000. California, 59. Utah, 37. So by all means, go ahead, run out, go buy a house in Washington. Go buy a house in California. Go buy a house in Utah, right? And if you already did, I'm sorry, because more than likely you're down a lot of money. The equity losses in those states reflect decelerating home prices, with all three posting annual declines in February and March. So at best, they've had what? 2.5 months of run up? 2.5 months of run up. That's it. But again, I understand the narratives out there. I understand why people are scared and frustrated. I share that. Okay. Now, despite these declines, home equity remains solid. Why? Because we had almost a 50% run up in 2.5 years. So if you bought before 2022, you're sitting like a king or a queen. Okay. Now, despite these declines, it does remain solid with the number of underwater properties unchanged since the fourth quarter of 2022. And although some major metro areas saw equity decline on an annual basis, years of rapid appreciation in places like Los Angeles, San Francisco, which have negative equity shares of 0.9%, is keeping homeowners in those metros in good standing. And you guys remember me saying this, I hope. I have said from the very beginning of my channel, homeowners are so strong right now that, again, before 2022. After that, you're dead in the water. But before 2022, they can afford to lose 10 to 15% of equity and still be okay because most people have like 30, 40% of equity and a 3%, 4% interest rate. So they can take a hit. The problem is, though, is the people that are buying right now cannot take that hit. National aggregate value of negative equity, Q1 of 2023. Take a look at this map. Okay, this is in percentage terms of negative equity. So it's saying that Texas had 1.7% of mortgages with negative equity. So this is saying the percentages of mortgages that are underwater. Okay, look at California. How is California? California is one of the most unaffordable places ever, and it has the lowest share of mortgages with negative equity. Isn't that astonishing? But look at Texas. This is where I'm at. Texas is like in the middle, actually below trend at 1.7. But look at these areas like right in here. Like this is Jeff's Hood right here. This is like, there's like very little new home building here where it's all red. And so there's like very little new home building here. It's still like relatively affordable here. And actually, surprisingly, that's not leading, but it's kind of almost, I would say the Gulf Coast nations are leading, but it's kind of leading negative equity to climb. Is that not astonishing to you guys? That is really astonishing to me. And look at Louisiana down here. And I'm telling you guys, New Orleans can become top 3 metro area of decline because also not only do they have 7% of mortgages underwater, they have by far the highest rate of default and foreclosure than any other state. Pretty crazy. But look at Florida. So Florida's been remaining strong. East Coast, I don't know how the East Coast stays so strong, being that it's so unaffordable, but it is what it is, you guys. Now let's look at this in a dollar number, okay? National home buying equity, okay, again, we went over this, but look at this. Let's put this in a little bit more perspective. So this map is updated. This is basically saying that if you bought this time last year, this is how you're doing, all right? So let's, anytime anyone wants to be bullish and say, oh, you're just for the views, blah, blah, blah. Let's just pull up this map. Like, for example, there's realtors in California, all right, that are on YouTube that are just, oh my gosh, I can't stand some of them, you guys. They don't even acknowledge anything. They're just like, yeah, just funny dealing by. Don't time the market. You can just refinance later. But any realtor, especially if they're on YouTube, that led their clients to purchase in California, you guys see that? The average person lost $60,000 in equity. Do you guys think the realtors feel bad about that? Do you think they're going to call their clients and say, you know what? I'll eat half of that. Here's 30,000. You pay the 30,000. Here's another 30,000. Do you guys even think that they're calling people to say, I'm sorry. You know what? It was your decision, but I'm sorry because I said that you could just refinance later. But now I see you've lost $60,000, which is your down payment. Sorry about that. I'm serious, you guys. And look at the Phoenix. Oh my gosh, I got so much hate in Phoenix, you guys. Look at this whole area in Nevada. Arizona. Look at this, guys. Negative $33,000 Nevada. Idaho. Look at Idaho. All these realtors on YouTube in Idaho, just buy, just buy, just buy. If they were saying that in 2022, the average person that they helped buy a house lost $33,000 from Q1 to Q1. You know what I mean? Like, and then they've had what, 2 to 3 months of run up, and all of a sudden they're right about everything, and they're the new geniuses, and we're the stupid people. Are you serious? You know what I mean? Are these people really serious on YouTube, you guys? Are these guys? And I'm gonna stop. I'm gonna get upset and look at Texas. Texas is pretty much balanced. You can see Louisiana, negative 3,000. Look at Florida, though. So there is an increase. So if you bought in Florida, so the Florida realtors, all right, fine. Florida realtors, I still believe in caution and affordability, but Most people made $25,000 in equity. Okay, so most people did make $25,000 in equity with the year-over-year comparisons. But remember this. How much, you guys, does it cost generally? Calm down, realtors, please. I know I'm going to get some hate, but how much does it generally cost to list your house and sell it, to list and sell your house? It generally costs 8%. Okay, so if the median house is in Florida is $400,000, 8% of 400,000 is 32,000. So if the average home is 400,000 in Florida, even though they had an increase of 25,000, that's not even enough money to pay the fees. Think about it, you guys. Think about what I'm saying. Anyways, really astonishing stuff here. And what's really blowing me away is the East Coast. East Coast is real crazy. Real crazy. So we'll just keep an eye on this, guys. I hope you like this map. I mean, Florida is just so expensive, you guys. Now look at this. CoreLogic provides homeowner equity data in the metropolitan area. In this graph, 10 of the largest cities by housing stock are depicted. Los Angeles, San Francisco, blah, 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 with negative equity shares to all mortgages. So guess who's in there? Houston. Do you guys know that Houston is actually the second largest metro area in the US? And that's where I live. Isn't that cool? But anyways, 1.4% of mortgages in Houston underwater. Las Vegas 1.1, San Fran 0.9. I don't know how it's so low. Los Angeles 0.9, Denver 1.6. Chicago's the worst of these at 3.8% of mortgages underwater. Washington 1.6, New York 2.6. So New York is taking second place, which is, I don't want to say it's good because I don't want homeowners to get hurt. Like if someone bought at the peak and has one of these really high payments, I don't want them to go into foreclosure, y'all. I would hope that people that purchased recently have a plan, right? Have a plan to get through it and are doing everything they can to do that. It is what it is, you guys. It is what it is. This chart shows national homeowner equity distribution across multiple LTV segments. Not really interesting information there. But now let me go here, you guys. Let's go into the Black Knight. I really appreciate you guys staying on with me. Do me a favor if you guys can, hit the like button. I'm trying to do the best I can to get you guys like the good information. We're going to go over this right now. I'm not really going to go into these charts too much, you guys, because really let me start here. Really all that I wanted to show you guys with the actual charts, not too much, just that. And this is for May. The average interest rate in May was 6.47. Okay. Average down payment, less than 19%. But I'm really looking at the refinances because the people that are doing cash out refinances are generally trading in a low rate for a high rate. And I'm not talking about HELOCs. I'm talking about an actual cash out refinancing, not a second mortgage, okay? Or home equity line of credit. Now, let's see here. Let me show you guys real quick. The gap is increasing on the 10 and 30. So I just wanted to point this out, all right? So, we used to need the 10-year to get to 4% for residential mortgage rates to hit 7%. That's no longer the case because the gap in the 10-year treasury, which is blue, and the 30-year fixed rate mortgage, which is up here for conventional or conforming, which is basically QM mortgages, this gap is getting bigger. All right. So that's actually that's not a bad thing. All right. This is not really interesting. But here's what I wanted to show you. So breaking it down, there's actually, so the market share of refinances, cash out refinances is 9%. So when we take out rate and term, we're at 9%. And that's interesting, you guys, because it also is showing this. Okay. So we're going to read here in a minute that Black Knight is basically going to say that there is some credit tightening because the average credit score for purchases right here is going up. So they're saying, oh, it's going up. So that means that it's harder to get a loan. So credit's tightening. And what I'm saying is no, that doesn't mean that credit is tightening. What that means is like a lot more people can't afford to buy a house because what we're seeing is credit go down in cash out refinances. And cash out refinances are generally harder to qualify for versus a purchase. That's why I'm looking at cash out refinance. It's a harder loan to get. Like, for example, Texas State has additional overlays the actual state of Texas. This is the craziest thing when I moved here. I was like, what? The state of Texas has additional overlays on cash out refinance. Did y'all know that? It's crazy, the overlays, but essentially you can never pull out more than 80% LTV. So the state of Texas says you can't take all the money out of your house unless you sell it. Is that brilliant or is that a bad thing? Last time it actually worked in the favor of homeowners because the home prices didn't collapse that much. But let's read some bullet points here. That's going to go into credit tightening. All right. Now, and then I'm going to go into the market analysis. Okay. Now, first thing is the Optimal Blue mortgage market showed 30-year conforming rates rose 27 basis points in May to 6.72 after holding between 6.38 and 6.5 for the first half of the month. So we're at about 6.72. Going back to Mortgage News Daily, let's see if this refreshed. So it has not refreshed yet. Let's take a look at the 10-year. Look at this, guys. 10-year is going straight down. Look at that. It's now down 9 basis points. Let me see if this is updated as well. Okay, so that's gone up. So it's kind of staying there. Anyways, despite jumbo rates remaining elevated, non-conforming locks, including jumbos and expanded guidelines like non-QM or bank statement loans, gained share relative to all other products in May. So that's not good, right? Okay, though. Overall, lock rate volumes were up 14% month over month in May. And understanding the money part of real estate is really important because follow the money, right? Now, purchase lock counts were down actually 38% year over year. And this is what Jerome Powell was talking about, Vital. At least this is how I took it. He basically is saying that the housing market is weakened. You and I don't feel that because we're looking at affordability, right? And affordability is price and interest rate pretty much, right? We're looking at affordability. I think he's looking at sales, right? Our businesses doing well. So purchase locks are actually down. The volume is down 38%, all right? And that's down 29% compared to pre-pandemic levels, just to put it in perspective. So again, you can make the argument that it's not fair to compare the last 2 years because there's been such explosive trends. But again, 29% lower than pre-pandemic. So it is bad. While purchase lending remains constrained, listen, it continues to drive the overwhelming majority of volume, accounting for 88%. So pretty much a lot more people are purchasing than refinancing, which makes sense. Let's see here. Let me read this part right here. This is interesting. Credit scores of conforming FHA and VA borrowers rose again in May, indicative, of tightening credit standards in an uncertain economic environment with purchase lock credit scores nearing record highs. So what they're saying is, again, and I briefly kind of summarize this, is they are starting to see some credit tightening. Now, I could tell you with my eyes, with my ears, I don't see it. I don't see it at all. I'm going to do another video today. We're going to break down how to monitor credit tightening, but overall, I don't see it. I think looking at credit scores is not necessarily the way we want to look at credit tightening because, again, the credit scores are going down for cash out refinances. So, okay. But it's interesting to see this is how they're perceiving credit tightening standards. Interesting. This is also interesting. The adjustable rate mortgages or ARMs share in May's of locked activity climbed to 8.41%. So adjustable rate mortgages have gone up 8.41%. Now that's a toxic loan. So yes, toxic loans are making a comeback. Those 0% down programs, all of that is making a comeback, which is especially dangerous. And that's why I didn't want to make that video that I did yesterday. And I have to ask myself, you guys, and this is really, and I think we're done with this, so I can actually look at y'all in the eyes. I can look at you kind of in the eyes. Let's see here. And then we're going to do the market analysis real quick. I totally lost my train of thought. I think it was about credit tightening. I don't even know anymore, you guys. I'm just so scattered right now. I am so sorry. Vegas. What's going on, Vegas? I see you guys. QMP. I'm 46 years old. Should I even think about buying? Okay. Let's put this one up here. And then I'm going to get back. Let me put this one up here, and I'm going to tell you guys what I was going to say. I have a dilemma, okay? First of all, I'm going to admit I have a strong opinion. When you listen to my videos, I have a strong, currently bearish, cautious opinion on the housing market. But at the end of the day, I know that I can't make people do things. And honestly, I think if I thought that way, it would be extremely unhealthy for me and for you. So I don't want anyone to let me do the thinking for them. In fact, I think that everyone should ask why. Everyone should not trust people unconditionally. But I also know that what I'm trying to say is, guys, is I haven't been really proactively giving you guys the value in the sense on how to find a great deal, how to house hack, how to get financing to get into a house with zero out of pocket. And I had to decide, like, man, like I don't have a right to withhold certain information. So I made that video yesterday, even though I don't believe that that's a program that like 90% of people should get, because down payment assistance programs have the biggest rate of foreclosure. But again, my goal is I want you guys to know what's out there and what's available so that when it is time for you, you're aware. I'm not saying that everyone should go drop everything they're doing and get the zero down 100% CLTV FHA loan. I'm not saying that. But what I am saying is it is out there. And if it's done appropriately, you can get ahead. But what I'm also saying is most people don't. And that is my dilemma. That is why I try not to do as many videos like that. Because again, you guys, I'm really deathly terrified that people aren't going to understand what I'm going to say. They're going to take the information. They're going to go out. They're going to abuse the program. They're going to buy. When I'm really just saying that right now you need to increase your purchasing power, credit, income, and assets, and probably we should hold right now. And also that it is an emotionally charged process. But let me answer this question. Then we're going to do a market analysis. And the market analysis is really good, y'all. I will have that timestamped here. If you're a realtor and you're watching, please pay attention to the market analysis. Take a step back from any cheerleading. Take a step up with using the data to help your clients find a home. But let me respond to this. QMP is saying, I'm 46 years old. I'm sick of this crap. Should I even consider buying a house? I want to give up. I have lost hope. Jerome Powell is saying one thing. The market's doing another thing. Prices are going up again. I quit. I paraphrased, QMP. I paraphrased, okay? And this is what I'm going to say, QMP. I got to be so careful here. I think everyone should own real estate, but at the right time. And this is not about timing the market. To me, this is about waiting for more data so we don't run into financial suicide. Okay, now having said that, I don't care, QMP, if you're 72 years old. I have to be careful. I think you should buy a house. I just don't know that the time is right now. Okay. And again, man, remember, I've helped 1,000 people put themselves into a situation to buy a house. Remember my first step for every one of those people, because I know how hard it is for people to say no. I know how hard it is for people to penalize you. Remember, I lost everything. I had to crawl my way out of the gutter. My man, the very first thing I tell every single person, stay encouraged. They want you to give up. They want me to give up. They want me to say, all right, it's time to buy, and lead all of you into purchasing real estate. They want me to do that, you guys, and they want you to quit. So don't do it, QMP. That's all I want to say. Don't quit. Don't quit. It's hard times right now, okay? Things change. They always change. That's all I'm saying. Now, let's do the next thing, you guys. I'm going to do the really, really valuable thing now. You know, because I get a lot of hate. Like, Travis, show people how to find a good deal. It's like, dude, I do that all the time, you guys. I'm showing people how to find a great deal. So now we're going to do how to find a great deal. Did I write down Artavia? Here it is right here. Okay. Let me switch my cam. And let me pull this up, okay? I'm going to show you guys, so follow along with me. All right, now we're accessing MLS. We're accessing live data. One of the big advantages of MLS is not just seeing active data, but also accessing sold properties. That's what all of these people are using in their algorithms. They need the sold property data just to have an algorithm. So again, I'm saying many realtors are not that good, but there are some great realtors, and great realtors will do this for you. And because you guys know, it's going to take me 5 minutes to do this. So what I'm going to do is I'm going to do a market analysis, a brief market analysis just on price per square foot for a subdivision here in Texas. Now, before I look at active listings, I first want to know what homes were selling for last year. So I have at least a foundation of, am I getting a good deal or am I not getting a good deal? Now, if I was truly purchasing, I would go back to 2020 and 2019. And in addition to a normal market analysis, I would also do a rental market analysis, but I'm going to hold the rental market analysis out for the sake of time, and we're just going to do a value market analysis, okay? And again, I'm going down to the subdivision. You guys should know real estate is hyper local. Like, I have people, even before I started this, a friend texted me and he's like, I could buy a house, it's only $50,000. Is that great? What do you guys think my first comment was back to him? I'm like, bro, you're my friend. I don't know if it's great. What does the data say? You don't know if it's a good deal without the data. Even my own friends are getting caught up in this. But anyways, if you're a realtor, I want to look at all sold properties for 2022. So I check the sold properties. All I'm doing is putting January 1st of 2022 through December 31st of 2022. I'm typing in Artavia right here because I'm going to do an analysis for Dan Carr. Because he keeps asking me to do one for this one. I don't think he's online. But anyways, I'm going to hit results. Okay, I'm going to select all of the data. So it analyzes all of the data. I'm going to go to stats, tabular. Is someone timing me? Okay, and we want to look at the adjusted price per square foot. So the adjusted price per square foot in Artavia for 2022 was $178.84. Average close price was $468. I don't care about that as much as I care about average square foot, because you don't want to buy an overbuilt house if you can choose. I mean, if it's my primary residence, I like more bang for my buck. But like when it comes to investments, usually the bigger the house is comparatively to the other houses, it's harder to sell for that price per square foot. But anyways, 2,700 square feet or 2659, you can see that. But I have this key piece of information right here, which is my price per square foot average for 2022. So listen, guys, what I'm saying is this. Like a realtor should be doing this for you. I have now equipped myself with data. Okay, so now I'm going to go back here. I'm going to just look at the active listings. Okay, and I'm going to type in Artavia. I really thought this was Artavia. I thought this said Artavia. It's not Artavia. It's Artavia. Personally, I feel like it should be Artavia. What show is that from? Is that from The 100? Can you guys tell me where Artavia is from? Have you guys seen the show 100? Isn't that the main character's name in 100? Is it Artavia? Isn't it? I don't know. Tell me if that's Artavia in the show The 100. It started out as actually a good series. Okay, so anyways. So now I have 97 active listings localized to the subdivision. Let's look at results. You guys should know exactly what I'm going to do next. So now I have 97 active listings for Artavia up. I'm going to categorize now by price per square foot. Okay, and look it. And remember, the average was $178. Look at this. I have 153. It's starting at 153. Let me zoom in. You see that? Look at well under 2022 averages. Do you guys see that? Look at this. Look at this. Look at all of these houses under the 178. Let's go to the second page. I zoomed in a lot just so you guys can see. Look at it. So second page, we're still going down. We're going down and right here. So the total 631, let's see. 631 is 37 listings under 2022 values. Do y'all see that? So 32, let me just pull up my calculator. I don't think you guys can see my calculator. You can't. 32 divided by 97 equals 32.9% of the inventory in Artavia is selling for under 2022 values. So there's still good deals and there's still places where value is going down. I honestly didn't know I was going to be walking into this like this, but let's look at the very first property. Ooh, look at this, look at this, look at this, look at this. Let's look at the second property. So the second property, only $156 a square foot, which means that's $23, okay, under 2022 values, which represents roughly probably like 14%. And look it's got my square footage average. My average square foot, remember, is about 2,700. That fits it. So I'm like, oh, okay. Okay, this one's lining up. This one's lining up. It's not too big like I'm used to. $156 a square foot. Let's look at the pictures. It's nice. Boom, boom, boom. Very nice. Very nice. And see, y'all, that's how you guys do a market analysis. So let me pull up this question real quick here. Let me go back over to this cam and go here. All right. So that is that. You guys, we finished that market analysis in 7 minutes and I was rambling. So if you call a realtor and they refuse to do that for you, do you think that you should stay with them? Probably not. I really hope you guys enjoy my lives. I try to put so much information in there. So, okay, let's see, Jason. Jason says, Travis, what are the main data points that showed you housing prices were not going to go down in a meaningful way? So I think what they're asking for, let me switch cameras. Let me go back over here. I think what they're asking is like, why am I saying that houses are going to go down again? I think that I always try to see like, okay, what are people really trying to ask me? Let me go into the Case-Shiller case. And I would say in a meaningful way, why aren't they going to go, wait, the other point said, we're not going to go down in a meaningful way? I'm saying they are going to go down in a meaningful way. So I'm actually, okay, so let me read this again. So what are the main points that you showed for housing prices were not going to go down in a meaningful way? Oh, okay. So like the bullish narrative. Okay, so I think that Jason's asking, what's the bullish narrative? Like, why are people saying that home prices are not going to go down? The number one thing is inventory. People cannot get off of inventory. Number two reason I believe that people are saying that is the liquidity that was pumped into the market in March of $400 billion. And then we have the seasonality. Then we have the hot labor market. And then there was one other thing, and then the tax returns. So tax returns start around March. That's why a lot of people start buying again. But that's what the other side of the coin is essentially saying. Inventory, pretty much it's just inventory. People are saying there's going to be no price decline because of inventory. The thing is they're also saying there's going to be equity increases as well. And they're also saying all kinds of other crazy things. But I think that's your question, man. I'm sorry. I should have read that clearer. I think so. I think it was. So anyways, y'all I think that's going to do it. I got to get editing on that video, but watch this evening's video. Again, I looked at 6 factors on all 4 Texas metro areas, Houston, San Antonio, Austin, and Dallas. And remember, you guys, I looked at migration, right? Because I was like, okay, Seattle, San Jose. So I looked at migration. I looked at building permits, right? Because building permits are important. I also looked at unemployment, San Jose, Seattle. So I looked at unemployment. I looked at price run up. I looked at unaffordability. And the most important thing that we all think, anyways, inventory. And I have found shocking things about like what's consistent in Texas, at least, for price decline. And it's not at all, a little bit, but it's not what I expected. It's actually, this data is so wild. This data is wild. Anyways, you guys, oh yeah. The deep, my thoughts, the deep, rewind this because I started this video out by telling you my thoughts on the Fed presser yesterday. It was a complete shamble. It was a complete joke. Jerome Powell was not answering questions directly. Most of the questions were related to the housing market because most people care most about the shelter that they live in. So, yesterday, in other words, was the first time that I looked at Jerome Powell as Ben Bernanke and completely useless puppet. It was super depressing, you guys. He couldn't even answer questions. And I'm saying we have a right to know these things. They're messing with us. Now, as far as Boise, I don't have my stuff up for Boise, but let me tell you, Apple TV, I want to do Boise again. But if I can't do it right now, all you have to do is if you go to Google, type in Redfin News, not just Redfin, you have to put Redfin News and then go to the data center. And the data center will allow you to access Boise. Altos Research will also allow that. Zillow has a report that will allow that. The Reventure app has so much data on Boise. So please do that. I'm sorry I couldn't do it today. What? Thanks for calming me down. Todd Sex was a downer. You're welcome, man. But listen, dude, like, I gotta be honest with you, man. Like, I'm not trying to calm people down here. I'm trying to like help people be aware. I don't think that we should be I'm not trying to calm people down. Okay. Honestly, I think that being nervous can be actually a good thing for people. Being hesitant and fearful of making the wrong decision can actually be a motivator. But thank you, brother. And I absolutely love Todd. You guys, I'm telling you right now, his heart is absolutely in the right place. I love all my people. I love Orlando, Luke, Scott. Man, there's some good people. I really enjoyed talking to Minority Mindset. I've talked to RJ Talks. I haven't had him on my channel. I can, but man, no one has the heart of the guys that I've been working with from the beginning. Even Michael. I mean, these guys I can actually be friends with. We could talk about real stuff. No, it's not just a business. Definitely respect all the other guys though. Anyways, you guys, that is going to do it. Thank you, Apple. Thank you. I'm sorry I couldn't get into more of that. And some of if that is thanks to you. Jo, it's not me, it's you, right? These are my opinions. Here's the links to the data, credit income assets. I believe in caution. At the end of the day, if you make a wrong decision, society is going to blame you. Remember that. We saw that with the Lennar homeowners that I interviewed. There were people that were like victimizing the home builder. Can you believe that? Like, society says that as consumers, we need to know as much as the professionals. It's broken. The whole thing's broken. That's why there's several lawsuits. No, that wasn't me. That wasn't me. That wasn't me. The audio. I really regret not stop. I was a little bit starstruck with Minority Mindset, and I didn't stop the interview and fix his audio. Oh my god, I got lit up by a buddy of mine that is a YouTuber. He's like, dude, what's wrong with you? I was like, I don't know. I'm sorry. Moving on to the next. But anyways, you guys, definitely appreciate you all. Melissa, please like the video, you guys. Kim, appreciate everyone. I'm going to get out of here, you guys. I got to go do an ice plunge right now. Again, I'm on day 6, an ice plunge, and then I got to finish the editing on that video. I'm going to make another video today on credit tightening, but I definitely want you to catch this evening's video because I got some juicy stuff in there. Wait, Janet, what's up, John? I didn't mean to skip you. Oh, my man's buying in Kingwood. I see some of these comments. You guys are funny. Janet, my man, love you all. Love you all so much, you guys. Now I'm going to get out of here. I'm going to do those things. I'm going to go get freezing cold right now and go through all of that pain. And other than that, guys, if you're out there investing in real estate, you already know I wish you luck and I hope you win.